Good afternoon, everybody. This is a very interesting topic, which I think we have been listening to all the structuring reforms in the banking sector in Europe and outside Europe, in the US and other regions of the world, especially that the banking sector has been at the spotlight since the financial crisis. And I think a lot has been happening already in terms of the regulatory reforms, especially the Basel III reforms. Obviously, in Europe, we would have liked to see more happening in terms, especially in terms of the leverage ratio, and then eventually even having more stringent requirements from a regulatory point of view. However, we are linked also to the macroeconomic environment, which in fact Europe, it's into recovery, and it's important to link this to any very stringent reforms that could happen in the banking industry. Especially the banking industry, it's the heart also of economic development, and it's very important to find a trade-off between economic recovery and financial stability, and this is a very, very difficult question from a policy point of view. Now, I would like to introduce this session by saying that the structural reforms is an important tool or an important policy initiative to ensure that the too big to fail problem is addressed, and also to ensure that the excessive leverage and whatever is in terms of the undercapitalization of the banking industry is looked at. Also to ensure that the large banks and large financial institutions that are well supervised. Obviously, many economists have been saying it's important to separate, just going back to the previous separation between investment banking and retail banking, or just not having the proprietary trading within the institutions. But yet, we don't have very clear research that shows that this is the best way to go for the banking industry, especially if we are talking about an integrated banking sector, which is difficult to look at from that point of view. Now, what are the potential implications eventually of these structural banking reforms? And again, a lot of research needs to be done to ensure that these type of structural reforms might have the intended effects and not produce an unintended effect, because for the moment we need also to look at the financial reforms as a whole. We have the Basel reforms, we have other types of reforms, which we need to look at them from a comprehensive point of view. Now, what are the potential implications of these structural reforms? First of all, we can see that there might be some changes in the cost of capital or the pricings of risks, with effects on, obviously, risk-takings of the financial institutions and the level of implicit government guarantee changes in the funding models and funding profiles. What it means that many banking institutions might even change their business models, and they move toward the homogeneous banking models, which eventually not necessarily the most stable one. And it's not by breaking the institutions eventually that institutions might move toward the most stable one. Now, we have done some research on business models, and we have seen clearly that many business models that have behaved in a different way in different phases of the crisis. Some of them, they have been very risky, and then they leveraged the risk, and they moved toward a more stable directions. But others, they have continued quite risky and over time, and then eventually they simply continued their own operations. So, in fact, the impact on the business models is very difficult to look at from a static point of view. We need to look at it from a dynamic point of view. because risk accumulates over time, and then there is a need for monitoring of this risk profile of all these financial institutions. We break them into two or into many parts of them. It doesn't really mean much, because overall risk taking, it is a dynamic, it's a dynamic function. Now, also, there is another risk which I see happening, is the shifting of the operations to less sophisticated banks, and even not banks, which are not even regulated banks. It's the shadow banking, especially if we look at simply the proprietary trading. Before, some banks, for example, in the countries where they have applied not the application of the proprietary trading, in the US, for example, other institutions will have to do it. Which are those institutions? Who is supervising them? And what would be the implications of these institutions on the systemic risk overall? So it is important also to look at this from a very, I would call it, cold point of view, because it's not a matter of responding at this stage. I mean, the crisis has been happening since 2008. We are in 2014, so in fact, there are many reforms that have been already implemented in the EU and elsewhere, but it's important also to look at this structural reform from an impact. What would be the impact of those structural reforms in Europe? Now, the next impact could be the changes in the organizational and operational structures of the banking groups that operate in jurisdictions which are adopting or not adopting the structural reforms. So what would be the implications of those type of institutions? How will the financial institutions be organized? Is it through subsidiaries, through branches? Maybe only through subsidiaries to ensure that the risks are really put within one single institutions, and these are very, very important changes that need to be very well assessed by the appropriate policy makers. Now also we need to look at the changes in the extent of cross-border activities of financial institutions, to what extent those cross-border activities will continue or not. And this is also important in terms of capital and liquidity across the border. And again, it is linked to the fact that some institutions would be either operating through branches or through subsidiaries. There are many other implications also that would lead to some thinking, very fundamental thinking. It's also the resolvability of banking institutions. Will it make it easier? Will it make it more complicated? So these are all issues that probably today we have the opportunity to discuss with our panelists. And again, there is one aspect which I think it's quite important to think of, is the impact on competition, the impact on integration, especially if we're talking about Europe. Europe, we are hoping that Europe, at least with the banking union, we are moving to a more integrated financial markets, and eventually also with the capital market union. So these are all issues that we need to think of in terms of competition, in terms of market concentration, and also in terms of the level of integration if we were to apply these type of structural reforms, and who is going to apply these structural reforms, which institutions. Like, for example, if we look at the proposal by the European Commission, that it is only applied to certain numbers of banks. What about the others? How can we really touch the other banks which are below the threshold, and ensuring that these are also, if the regulation would be applicable, how it will target those ones that are outside from the beginning.